Hello everyone. I hope you and your family is safe and doing well. Today I'm here to talk about two new offerings which Mirae Asset is coming out with, and both the offerings, which is an ETF and a fund of fund, will track the performance of S&P 500 top 50 index. Now these both avenues are provided so that investors can choose based on their preference which medium to use to invest in this particular portfolio. If you have a demat account and you prefer to buy and sell on the exchange, you can use an ETF to take exposure in this portfolio. Whereas if you don't have a demat account, or if you prefer to transact directly with the AMC, just like a normal mutual fund, or want to use facilities like SIP or STP, you can use the fund of fund. Now, before I go ahead and talk about this offering in more detail, let me first give you an update about the US market. So US has posted strong GDP numbers in quarter 1 and quarter 2 of this calendar year. In fact, in first quarter it grew by 6.3%, and in quarter 2 it grew by 6.5%. Though while it was a bit lower than expected, but it is still very strong numbers after the COVID pandemic. And this year it is expected to grow in the range of 6 to 6.5%, and next year it is expected to grow around 4.4%, which is in fact more than the expected growth of emerging economies put together, which is very good. Now consumer demand is basically behind this revival. We are seeing very strong consumer demand, especially in goods, which is backed by the savings in excess of $2 trillion. It is also backed by strong job numbers, which is coming out. Last year in July itself, US added around 9.4 lakh jobs, and also the wage increase which we are seeing in US for the laborers. Apart from it, it is also very interesting to see that a lot of companies are coming out very strong numbers. In fact, if you look at uh, S&P 500, almost 80% of companies have beaten the analyst estimates, and they have beaten the analyst estimate by an average of 4.9%. This number is highest since global financial crisis. While inflation remains a concern, and inflation is around 5.4%, but it seems to be transitionary in nature, with plateauing being observed in a lot of underlying components. And Fed is keeping a close eye on the inflation numbers, and they also believe that this is transitionary in nature. And as expected, they are going to proceed with the interest rate hike in first half of 2023, and the taper, which is reduction in the bond buyback program, in either late 2021 or early 2022. Now, in coming quarters, it is expected that consumer demand will also pick up in services also, like it is picked up on the goods side. And market continues to focus on strong US macros and corporate earnings, and as of now is less concerned about the inflation. And if this continues, we expect US market to do well from a long-term point of view, while there may be short-term volatility. Now, S&P 500 top 50 index, the motto is very simple. The idea is to capture the US mega cap companies, companies which are bluest of blue chips, companies which are sector leaders in one portfolio. This index consists of 50 mega cap companies across sector. So unlike a lot of other products which are, let's say, tech centric in nature, this portfolio is sector agnostic. So from across the sectors, whichever company is in top 50 based on free float market cap within S&P 500 will become part of this portfolio. And as you can see, it provides exposure to companies like Intel in semiconductor space, which has more than 3,400 patents. It provides exposure to companies like Apple, whose MCAP is around $2.4 trillion in technology products. It provides exposure to Johnson Johnson, whose credit rating is higher than the credit rating of US government in healthcare space. It provides exposure to Berkshire Hathaway, which is one of the most profitable company in in the world in financial service space. It provides exposure to Disney, which has added 100 plus million subscriber in its new online streaming platform in media and entertainment. So you are getting exposure to these wonderful set of 50 companies which are sector leaders and which are establishing new benchmark for others to follow. And it is not just scale. In fact, the recent study by Boston Consultancy Group says that 20 out of these 50 companies are the globally most innovative top 50 companies. And that is also important, right? Because these companies are out with very strong suites of products and services, and the way they are innovating, they will continue, hopefully, to maintain their dominating position in future also. And if you take exposure in this particular portfolio, your wealth is expected to grow as these companies grow from a market cap point of view. And if I just put a sheer number to it, it's huge, right? The aggregate MCAP of these 50 company is $23.2 trillion, which is more than 8 times the size of India's GDP. The net income of these companies in aggregate is more than $560 billion, which is more than the much more than the net income of all Indian equities put together. The cash balance of these companies is more than $800 billion, which is 30% more than the cash balance held by the RBI. So these are mega caps in true sense. So what are the advantages of S&P 500 top 50 portfolio, and why investors can assess this particular product to take exposure in US market? First of all, like Nifty 50 provides exposure to blue chip companies in India, this portfolio will provide exposure to the 50 mega cap companies, the bluest of blue chip companies across sectors. It has a sector agnostic approach and it is not sector biased. For example, if you look at a NASDAQ 100 or a FANG Plus index, those are tech centric products, whereas this particular product is is providing exposure, as I mentioned, to healthcare, to financial services, to IT, to consumer discretionary, etc. Whichever is forming part of this top 50 mega cap space, you will get exposure to that particular stock and that particular sector. And that is probably one way to take exposure in US markets, right? It's a tech dominated market and it has done really well. If you compare it to Nifty 50, historically US markets have generated significant alpha. So one way to take exposure in US market is to invest in these tech centric products like FANG Plus. But it comes with higher risk and higher volatility. While it has generated better returns, it comes with higher volatility. You can complement that exposure with sector agnostic, non-sector biased product like S&P 500 top 50, which while has delivered probably lower returns than a FANG Plus, but it has delivered much better returns than Nifty 50 historically, and it has done so with lower risk. In fact, if you look at last 15 calendar years, in each of these calendar years, S&P 500 top 50 is less risky, has lower volatility than a NASDAQ 100 or a FANG Plus product. So Here, you can get the exposure to US market with a lower risk and with a product which has delivered better returns than Nifty 50 historically. Now, let me go in bit more detail and talk about performance, right? So S&P 500 top 50 has very high correlation with S&P 500, as you can see, but it has outperformed it, as you can see in the graph. It has also outperformed Nifty 50 significantly. So since 2011, the S&P 500 top 50 has become 7.8x, whereas Nifty 50 has become around 2.9x. And if we look at periodic performance, as I was mentioning earlier, you can see that in last 10 years, S&P 500 top 50 has given 22.6% return, which is almost 10% more than Nifty 50. If we look at 3 years, it has given around 11% more return than Nifty 50. And again, if we look at 2 year period, it has given almost 12% more return than Nifty 50. So historically, over a longer period, S&P 500 top 50 has given better returns than Nifty 50. And this is the evolution which I was talking about earlier. The S&P 500 top 50 index reflects the changing dynamics of the market, like Nifty 50 does. As the market has evolved, so the underlying portfolio has evolved. For example, if you look at 2005, you will see that IT only has a weight of around 19%, whereas financials have a weight of around 20%, and energy has a weight of around 11% in the index. After global financial crisis in 2011, if you see, the IT has increased from 19 to 22%, whereas the financials have dropped from 20% to 14%, and energy has somewhat increased to around 16%. But fast forward it to 2021, now when we are seeing that there are more bigger companies in tech and consumer discretionary space, you can see that index has also evolved. It has now around 38% exposure in IT, around 13% exposure in consumer discretionary. It has 8% exposure in financials, which has obviously reduced over the period of time, and around 2% exposure in energy. Now, taking exposure in such product is beneficial because in future it will continue representing the market because its methodology is devised as such, right? Whichever sectors are there in mega cap space, that gets represented. So for example, if 1 year down the line, if healthcare sector grows in terms of market cap, the healthcare component will also increase, and that is what is beneficial in taking exposure in a sector agnostic portfolio compared to a sector biased portfolio. And looking at the current portfolio, as I was showing earlier, IT has weight of around 38%, healthcare has a weight of around 12%, financials have a weight of around 8%, communication services and around 18%, and consumer discretionary around 13.5%. And it is very different from a lot of tech centric portfolios. While IT is still around 38%, but that is the nature of the US market right now. But with this portfolio, you are getting a good exposure in financials, a good exposure in healthcare companies also. Looking at the portfolio at the stock level, you can see the top companies are the major tech companies. Apple at 11.4%, Microsoft at 10.7%. Then comes Facebook and Alphabet. But then as you go down, you'll also see Tesla at 2.6%, Berkshire Hathaway 2.6%. Then comes Nvidia, JP Morgan, Johnson Johnson, Visa, etc. So you're seeing a good suite of companies across sectors forming part of this particular portfolio. And it is very important to point out one fact that the index will only consist of mega cap companies which are listed as well as deemed to be domiciled in US. It will not consist of companies from other geographies which are just listed in US. The index is rebalanced once in a year in the month of June. And if we look at last 5 years, on an average, four stocks have come in and four stocks have gone out. And that keeps the portfolio relevant to current market conditions. Now, just to conclude, S&P 500 Top 50 ETF as well as the fund of fund seeks to provide exposure in 50 bluest of the blue chip companies which are listed and deemed to be domiciled in US. It intends to provide exposure in a sector agnostic manner, and the index is expected to evolve as the market evolves, right? As it has done so in its history. It has given much better returns than Nifty 50 historically, and it has had a lower risk than tech-centric products like NASDAQ or a FANG consistently in last 15 calendar years. And finally, it provides a low-cost avenue to take exposure in the US market through the ETF or the fund of fund. Now, the NFO opens on 1st of September for both the ETF as well as the fund of fund. The NFO closes for the ETF on 14th of September, and it will close on 15th of September for the fund of fund. The allotment date for the ETF is 20th September, which means that the deployment will happen at US market close on 20th September. The scheme will reopen for subscription and redemption directly with the AMC from 22nd of September, and this scheme will get listed on the exchange within 5 working days from the date of allotment. In case of fund of fund, the scheme will open on 23rd of September, and here you can use facilities like SIPs, STPs, etc., or can do a lump sum investments also. And this fund of fund works like a normal mutual fund. So that's it from me. Thank you for watching this video about our new NFO, which we are coming out with, where an ETF and fund of fund will be tracking the performance of S&P 500 Top 50 Index. Take care and goodbye.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.